Okay, it looks like we've got a few people still joining us, but we'll go ahead and get started. Let me introduce our MC for today's webinar, Mark Abrams. Mark is a partner in our tax practice. Mark, I'll let you get us started.
Thank you, Misty. Good afternoon, everyone. Thank you all for joining us. We look forward to having a great discussion around this very timely topic. We'll be addressing recent legislative changes and tax strategies that business can leverage to minimize their tax burden, something that I think we can all agree would be a good thing to do. Our content will offer up-to-date information on legislative changes, tax credits, and incentives. We also focus on tax considerations for 2023 a little bit. Before we get started, there are a few housekeeping items. During the presentation, we will ask 3 poll questions. For those interested in CPE credit, you must participate in each poll. Following the webinar, we will send you a link to a survey. Like the poll questions, you must complete the survey to obtain CPE. And last, we encourage you to submit any questions through the Q&A feature throughout the webinar. Our team will monitor them and will answer as many as we have time for. All right, let's go ahead and get started. Here are your panelists today. I'll start the presentation and pass the baton to Cass, and Scott will pick up, and then we'll close out today. In a brief intro to Smith & Howard. Smith & Howard is a family of companies built to help our clients. We have grown to over 160 high caliber professionals in Metro Atlanta across the nation. For 13 consecutive years, we've been voted top workplaces by the AJC. We also are best of best firm as voted on by Inside Public Accounting. We serve clients both locally and on a national level. We are driven by core values, our clients, our people, excellence, and integrity. We're also a dedicated tax team that follows COVID-related legislation in Congress. And like this presentation, we're committed to proactive communications with our clients. Our agenda for the day will review some of the updates that have occurred this year. There are 2 major tax changes or tax law provisions that came out. We'll cover at a high level method changes in elections, and then other tax planning strategies to generate cash flow. There are some specific considerations for flow-through entities that we want to be sure to address. If you have international operations, there will be some specific comments there as well. In today's market with highly competitive workforces, there are incentives related to employee benefits. SALT primarily means state and local tax, income tax specifically, that we'll address today as well, because the states look at this a little bit differently. For corporations that require income tax provisions, we will address some thoughts there as well, and then finally recap some final remarks as we plan for the future. Let's get started with some recent legislative updates. The commonly known largest bill that passed this year was the Inflation Reduction Act. Whenever Congress proposes legislation, they have revenue raisers and they have incentives that they're trying to stimulate. The largest revenue raisers that they added to this stimulus were in the form of this new 15% alternative minimum tax for large corporations that have book income in excess of $1 billion. We'll cover that briefly. There are some other revenue raisers there that we're not really addressing, including increased IRS enforcement activity, which requires a lot more hiring so that they can increase their examination exposure rate. There's a number of things that help taxpayers, including modification of the many current energy-related tax incentives. There's credits, there's deductions, there's enhancements to those provisions. And finally, this is kind of a revenue raiser as well. There's, for flow-through entities, a limitation on how much loss you can take for businesses that end up on a 1040 or 1041. Those are personal returns. Married taxpayers are limited to $500,000 in net losses a year. That provision has been extended for 2 years out to 2028. I mentioned earlier there are tax credits that were added to the bill. Those have actually, there's a relatively new feature that we haven't seen on the federal credit side. There's an ability to monetize those credits and transfer those credits if you can't use them in 2023. So look for more information on that if you're trying to cover a tax bill. There could be some tax leverage there if you're looking to pay a bill at a discount, perhaps. The CHIPS Act is fairly focused. If you are in the semiconductor space, there's some new credits there, including a 25% advanced manufacturing investment credit. As you may know, there's been a slowdown in logistics. It's hard to get chips over here. There's a lot of stimulus to try and onshore some of the production activity to expedite production of vehicles, computers, any technology that might be needed in the United States. If you do not have book income more than $1 billion, you really don't need to pay attention here, but this is a new revenue raiser. In 2017, the AJCA reduced or eliminated corporate AMT tax, but now we have a new version of this AMT tax, which is a revenue raiser. It's designed to generate at least a 15% minimum tax on large corporations earning more than $1 billion of adjusted financial statement income. The adjustments that are involved there are fairly straightforward. You have to look at a trailing 3-year net income history to determine whether you exceed the revenue hurdle or net income hurdle to determine whether you are subject to this tax. Some of the adjustments include adjustments to a federal tax depreciation estimate, add backs for taxes, and so forth. If you are a large corporation, these are some new things to think about for 2023 as you plan ahead. I mentioned the ability to monetize credits by transferring them. So if you have credits and you can't use them, there is the ability to transfer them. For nonprofits, there's a new direct pay system that they've employed that could convert what otherwise might be a credit that could be used, but if there's no tax to pay, nonprofits may be able to monetize these credits and receive cash in lieu of the credit.
And Mark, I'll just jump in real quick here. I think this is an important piece to highlight because in some years there may have been credits available for certain businesses. And when we say, well, we're in a loss position, we've made a lot of investments, we're not paying tax this year, we're not even expecting to pay tax next year, years after that. This new law will allow for certain of these credits to actually receive cash. So it's a little bit similar to like for startup businesses, the R&D credit, you can get some payroll tax offset. So you can turn that credit into real savings for the business. So while this still, you have to actually have a relative business for these credits to apply, there are situations we're seeing where people said, you know what, it's not worth chasing this credit. I don't have the tax to pay it. Now it becomes a much more strong benefit.
Thanks, Scott. That's a good point. There's a long list of these credits. We're not going to go through the provisions here, the details of each. I will say broadly that there are credits like solar and geothermal that have been expanded. They've increased the credit rates. Energy efficient home production is one, the 45L credit. If you're a multifamily developer, this could be important where you're getting up $5,000 per unit credit if you're building things above a certain ASHRAE standard. But generally speaking, there's a lot of incentives in here for clean energy development. What made the news a lot were the energy credits or the EV credits for cars and vehicles. They've expanded those too, and they've also made it available to used EVs for the first time in history and changed that program. But there's a requirement that the battery components need to be primarily made in the US. Right now, all the major car dealers are ramping up US production to try and accommodate that. There are income limits as well. So when you get into credits, you need to be aware that there are limitations. You may not be able to take all the credit. For example, there's an overall credit limitation for investment credits that taxable corporations can claim. You need to be aware of that. And you can't stack certain credits if you are doing some of these activities, generating clean fuel or clean electricity, solar, geothermal. If you have nuclear power generation somewhere in your portfolio, then you may be eligible for these additional credits. Next, we'll talk a little bit about methods to defer or accelerate certain items of income and expense. It's always important to look at this. The number one thing that we do as tax planners is we look for permanent tax savings. A credit is actually a permanent tax saving. A credit's more valuable than a deduction. But we also look at methods too. If you're an accrual method taxpayer, or if you can switch to an overall different method like cash method, opportunistically, there may be a way to defer income or accelerate deductions or vice versa. So there's two ways to do this. The traditional planning involves if you are profitable and you're anticipating increasing income, we often look at accelerating deductions or deferring income to try and reduce your taxable income in the current period. If you have other situations where, for example, you may have prior loss attributes or you have losses this year, you may be interested in flipping that around and trying to accelerate income and defer deductions. That is reverse planning.
And Mark, I'll just jump in again real quickly. I think the two most common things we're seeing with reverse planning right now, you have your traditional net operating loss utilization. That's one of the long-standing reasons for reverse planning. Another more recent development in reverse planning is avoidance of the BEAT tax for our large corporations. That came into play a couple of years ago, and that does require some potential reverse planning. And the other is that 461L flow through business loss limitation. So you don't lose those losses, but there might be benefit in slowing down the actual taxable loss to better manage that cash flow, better manage those deductions. So there's a couple of new reasons to be thinking about going the opposite way of what you would normally think of for tax planning.
We'll hit some of those concepts again in a few slides, but that's perfect. That's exactly right. And look, everybody's different. Everybody has a different set of facts. You really should talk to your tax advisors to make sure you're trying to tailor these types of concepts to your business. So traditional planning considerations involve looking at overall methods, looking at specific opportunities, things that might be capitalized on the balance sheet that you could accelerate for tax purposes. Keep in mind, tax methods do not have to match the GAAP methods, and oftentimes there are different rules for tax purposes. It's important to pay attention to these, but if you're looking at things each year, you do have an opportunity to review your methods and we've seen big savings. You know, if you think about some of the changes that occur with fixed assets and methods, and if you miss deductions, you can go back and clean up a lot of stuff in 1 year. And we've seen some large deductions that get triggered just by correcting methods. So few concepts. Although codified in 17, the advance payment rules generally require that you can't defer income greater than a year beyond the year of collection. There are options that you can use to accelerate or continue deferring. You need to look at those methods that are available to you, depending on your facts. Look at those advanced methods. I mentioned this already, changing from an overall accrual method to a cash method and vice versa. If your revenues are under 27 million on a 3-year trailing average, you can switch or use the cash method. You need to pay attention to whether you have inventory and whether you're a qualified business for that purpose. But if you meet the requirements, that might be one option. And certainly doing the opposite, going to an accrual method, can be advantageous. In general, if your receivables and accrual basis assets exceed your payables, your cash method taxpayers will produce less income or defer income. If you flip that around, if your liabilities exceed your assets, accrual method would generate a lower taxable income. Prepaid expenses. Need to know, we'll get into a slide later, that some things are automatic and some things aren't. And I'll tell you what that means later, but this, in general, prepaids, most of them, if you switch your method for accounting for prepaid expenses, for tax purposes, you may be able to deduct those. So for accrual basis taxpayers, if you have prepaids on your balance sheet, that could be an opportunity to take a deduction that you haven't taken for book purposes. There are also another set of rules that relate to how you amortize deductions and commissions and certain payments. You can look at those to determine whether you can accelerate those. In general, for compensation, you can accrue comp. You don't have to pay it unless you're a cash method taxpayer. Cash method taxpayers would time their deductions to the time they write the check or deposit the check, the income from the customer. For accrual method taxpayers, as long as you write the check 2.5 months after the end of the year, that payment, that accrual is deductible. Otherwise, it's deductible in the following tax year. So pay attention to your accruals for bonuses, comp, commissions. Make sure if they're not related party comp items that you pay those before 2.5 months after the end of your fiscal or calendar year. And a note on related party comp. If you have a C corporation or that where you have a shareholder employee that owns more than half of the equity of the company, that payment should go out before the end of the tax year in order to get a deduction. For flow throughs, generally speaking, all payments to shareholders of S corps and partners of partnerships should be made prior to the end of the year in order to control the timing of the deduction and get that deduction in the current tax year. Other deductions, other liabilities have different timing rules. Generally speaking, if they're ordinary, necessary, and they have a recurring nature to them, in other words, you see these things each year, you might be able to adopt the recurring item exception. Generally speaking, when we convert people to an accrual method, we're adopting initial methods, we always elect the recurring item exception because it covers other things that aren't comp that have a 2.5 month rule. Generally, if you write the check, you have to follow economic performance rules and the all events test. You got to write the check and the services have to be rendered within a certain period after the end of the year. This gives you an 8.5 month window. The recurring item exception is useful for most accrual basis taxpayers. The number one strategy that people think about, cash method and accrual method, is to control timing of deductions. Generally speaking, you have to purchase something. For cash basis taxpayers, they look at equipment. For accrual basis taxpayers, they also look at equipment. Equipment just doesn't show up nowadays. I just mentioned logistics is a challenge. And I'm not advocating buying things that aren't necessary for your business, but we still do in 2022 have the 100% bonus rules. This is the last year. If you've already purchased more than $1.080 million and can't use Section 179, or for some reason can't use it because of income limitations, but we still have 100% bonus where you can generate deductions by purchasing equipment. Next year, that steps down to 80% and gradually steps down to 0 by 2026 under the 2017 tax bill. A note on bonus versus 179 real quick. The states, generally speaking, do not like these accelerated methods, and they often will conform to most IRS rules except for bonus depreciation. So when in doubt, take 179 first if you can, and then claim bonus next on what's left. So there's some planning that can go into that as well.
And Mark, just real quick, the phase outs on that bonus depreciation, they do start at 80% next year and go to 60% in 2024. So really at 80% bonus plus first year depreciation, you're still in that 82 to 88% cost recovery in year one. So that's still pretty fairly significant savings. So if you have some major capital improvements that you're thinking about, now is the time to start putting those in place so that you can place those in service by the end of 2023 before we go down to that 60% limitation.
Right.
And before you continue,
yeah, go ahead.
I just want to let people know we have our first poll question coming up in about 3 to 4 minutes after Mark finishes his slide.
Yep. So if you're milling around, run back to your computer. A polling question is coming. So one more comment. I'm not going to address it in detail, but the interest expense limitation rules are changing this year. Cass will explain what that means in a little bit, but just know that the interest expense limitation rules are changing for 2022, and you need to factor that into your planning. I mentioned a second ago, method changes. This is, an area where I've seen, really home run results. Clients may have switched preparers or changed methods or changed controllers, and some of the lives and methods that they've adopted historically are inconsistent. You have an opportunity under the automatic rules to go back and correct errors as well. And if you do that, you can catch up depreciation. For example, if you did not elect out a bonus, which you can do, you can elect out a bonus and you didn't claim it, you could lose out on that depreciation deduction and be subject to recapture later if you sold the asset. That's a problem that we would want to fix, right? So you should look at that. And if for some reason you did not elect out, go back and catch up depreciation, and you can do that in the year of change. Very valuable. It's also true that for our clients that have inventory, a rising rate environment, rising cost environment, certain methods work out better than others if you're trying to minimize income. Last in, first out, for example, would generally generate cost of goods sold that is higher in years of rising cost. There are different methods and variants of that, but those are valuable considerations if you're looking to reduce taxable income. The rules have changed on success-based fees. So if you have a transaction, an M&A transaction for book purposes, you might deduct all that cost. For tax purposes, historically, you would follow a bright line test and you'd have to determine which costs were incurred prior to a certain date. But the success-based fees largely were either capitalized or deducted against proceeds. Now we have a safe harbor convention where 70% of these items may be deducted. So please look at those as you're preparing your provisions and tax estimates. Either electing de minimis safe harbor expenditures on small items. If you're audited, if the item is $5,000 or less, you can write that off as repairs, but you can also elect not to do that. So if you're doing reverse planning, you can capitalize those items to increase your income. Now we're going to cover poll question number 1. Which of the following phrases summarizes tax planning for you? A broken clock is right 2 times per day. I'll gladly pay you Tuesday for a hamburger today. When you get to the fork in the road, take it. There's no right answer. We're just really curious what you think. We'll give some people a few more seconds to recover from the trip, getting back to the computer screen.
Mark, I thought you were gonna hum the Jeopardy tune for us while this.
I could. That would sound. I could whistle it, but that's probably not going to be enjoyable.
We'll just all imagine it together.
Yep. I am a marionette. Look at that. When you get to the fork in the road, take it. Thank you for your responses. Very good. We will now proceed. Okay, so we talked about reverse planning a minute ago. So when would you really want to do this? If you have losses this year, just on current operations, of course, it might make sense to try and accelerate income. That makes sense. But a lot of times you might have some loss carryover. Scott alluded to it. There's different types of loss attributes or credits. It could be capital losses, net operating losses that are just sitting there waiting to be used. And in some cases, and Cass will cover this more specifically later, those may expire if you don't use them. So if you want to make sure that you use your loss attributes, you might want to start thinking differently about accelerating income and deferring deductions. So a couple of strategies that could be employed. You could trigger gain on a sale leaseback transaction. That's something that if you've entered into a transaction or you're contemplating, we don't have a lot of time left, but for fiscal year and taxpayers that end after 12/31, maybe you could accomplish that. You could also, if you have capital gains somewhere, whether it's investment property or stocks and securities, you can accelerate those gains to offset a capital loss carryover. If you did enter into a transaction to sell something and have an installment sale, meaning you've got cash collections that you anticipate collecting over a number of years, you can elect out of installment sale and trigger the entire gain in the current period. That works well if you have losses sitting there to offset it. You could also delay payments of liabilities. We talked about that, where the deduction might be related to the amount that's paid, cash basis taxpayers. This means something to you for the most part, but generally speaking, you have it on accrual basis taxpayers too. 2.5 month rule on comp. If you pay it after 2.5 months after the end of the year, then it's deductible in the next tax period. Wanted to mention this too. This is not new, but this is something that was enacted with the 2017 Tax Act. Research and experimentation expenditures for 2020 for years beginning after December 31st, 2021 are required to be capitalized for tax purposes. In the past, you could deduct those. And if you capitalize them, you can amortize them over a 5 or 15-year period. There are a number of very interested constituents that are trying to lobby for a back to the future event where they would like to deduct these things still and claim credits. That hasn't happened yet. There's some speculation that could happen in maybe a year-end reconciliation package, but there's not a lot of news on that right now.
Just a quick additional context there. Even if you are not claiming research and development credits, this law change may impact you. So the code section that describes research and experimentation expenses is larger than the things that qualify for the credit. As Mark mentioned, you're not losing those deductions, but you're just delaying them over a period of 5 years for US expenses, 15 years for international expenses.
Thanks,
The Senate
Scott.
voted 95-5 to delay this over the summer, but that was just a panel vote, wasn't binding. And as the days tick down to year end and the cost of delaying this becomes more apparent, we are becoming a little less optimistic that we will have this relief. So we do need to start thinking about this sooner rather than later.
Yeah, thank you for mentioning that. And I'll say also, research and experimentation credits are more widely available than you might think. It's not just lab coats and beakers. There could be, process improvements on existing production processes or certain types of software innovations or other developments that you're trying to capture in your business that may be eligible for research and experimentation credits. And remember, credits are more valuable than deductions. So you should, if you have questions about whether you have qualifying activities, talk to your tax advisor. A word on how to do it. We're not getting into the weeds here, but I mentioned earlier, you have to apply for method changes. The way you do that and why you do that is number one, you file a form 3115. And the reason you do that is so you can get audit protection in the event that the IRS were to examine you and you did not make a qualified automatic or non-automatic change, and you make certain changes in your flush it through, or you're just arbitrarily trying to change something on the face of your return and hoping for the best. That is not a great strategy when dealing with the IRS. So you would like to affirmatively apply for method changes and get approval before you do it to protect yourself from additional interest and taxes and penalties. An automatic change is automatically approved. It can be filed with your return or by the extended due date of the return. There's a very long list of those that would be very helpful to any business. There are a number that aren't automatic. And what that means is you have to apply for the change prior to the end of the tax year, and you have to wait to get approval to change that position on your return. Plus, there's a user fee if you do make a non-automatic change. And I'm not sure what that fee is, but I want to say it's over $9,500. So for timing differences, it makes it less palatable to make a change unless you really have a big item that you're dealing with, and it's going to be beneficial to do that for a longer term horizon. Tax method changes, just generally speaking, if they're favorable to the taxpayer, meaning they generate a deduction, are eligible to be claimed in the tax year of the change. So the depreciation example I gave you earlier, if we find a bunch of additional depreciation deductions, we can absorb the entire beneficial adjustment in that tax year. For income items, generally speaking, unless there's a different method under the procedures, you can spread the income, the unfavorable adjustment, over a 4-year period, generally. I'm going to pass the baton, I think, now to Kaz Pittman, who will address some additional common planning strategies. I do see that we have a question. If you would like to address those now, Misty, please advise, or we can keep moving.
We can go ahead and answer it if you want me to read it to you.
Sure, go ahead. What is the question?
Okay, for tax planning for PPP loans, what are the options to use the loan for tax basis in the year prior to the year of forgiveness?
Scott, do you want to address that, or would you like me to do that?
Sure. So I think the key determination is when the application for forgiveness is submitted. So to real briefly back up, the PPP loan generates tax exempt income. So we report it as income for our books, but for taxes, we do not have to pay tax on it. Yet we get to increase our basis either in our stock or in our partnership for that loan amount. The SBA and the IRS went back and forth on this, on what the right timing was for recognizing that tax exempt income. The general rules are when you apply for forgiveness with the expectation that you will receive forgiveness. So that means you met all the qualifications. So if the SBA is taking their sweet time, you do have the option to recognize that tax exempt income when you actually apply for forgiveness, not when you receive the notification. Now, the most conservative answer is when you get that piece of paper that says you're done, goodbye. But there is some flexibility, and we are seeing at this point in 2022, most of those applications should be processed by now. If you are still dealing with an issue related to the PPP loans, please reach out to me and we'd be happy to discuss that.
Thank you.
Well, thanks, Scott. And thanks, Mark, for all that on method changes and the Inflation Reduction Act. That was helpful. I was going to touch on some tax planning opportunities that should just be considered annually, and some changes that have come through that have kind of altered those kind of annual planning strategies as well. But just things that we find are useful for owners as they consider, what needs to be done before year end to help with cash flow. And I'm going to see if the slides are going to work for me there. Okay, so first off, bad debts and tax write-offs. So something to consider when you're thinking about taxable income for your year is that some items that are a deduction for book purposes and on your financials, your audited financials or reviewed financials, some deductions that are book deductions, certain things have to be done in order for it to also be a tax deduction. And so bad debts and writing off bad debts are one of these areas that we see, that especially at year end, to take a look and see, are some of the bad debts that are sitting in your reserves for book purposes truly uncollectible? And if so, go ahead and write those fully off, because for tax purposes, you're not going to be allowed a tax deduction for that bad debt unless it truly is completely uncollectible and written off on your books. We always recommend looking through there. Something along the same lines is with inventory reserves. We see this a lot with our manufacturers. If you have inventory reserves sitting out there for goods that you don't believe will ever be able to be sold, go ahead and make sure those are off the premises by 12/31. Go ahead and scrap them, donate them. We just need the actual product to be out of the premises in order to get that deduction. So a lot of times we'll see a large inventory reserve out there for obsolescence. It's sitting out there and you've taken the deduction for book purposes, but you're not getting that deduction for tax purposes. And until you can get it for tax purposes, you can't decrease your tax liability there. So that's one area that we definitely see that as well. And then something else just to look at, kind of in the same vein of making sure if something is an asset that is not good for the business anymore, that we're getting rid of it and completely writing it off so we can take that tax deduction. And that would be looking at any subsidiaries or any investments sitting out there. If they truly are insolvent, it's probably time to clean that up and try to get that done before year end if possible. So there's some expenses that, we always look at, but then coming up in this new year in 2022, we have some changes with how those allowable limits are structured. And so one of these items is the interest expense for businesses. Mark touched on it briefly in his section, but pretty much starting after 2018, we started to see this limitation that could be put in place for certain businesses with the amount of business interest expense that they're allowed. The calculation is what's changing. The formula stays the same, but what we can add into that changes, which I'll go through. But it is making it where businesses may be more interested in looking this year to see if they could fall into one of the exceptions from this requirement, which would be if you are a small business and so you have annual gross receipts averaging over the past 3 years of less than 27 million, if you fall into the category and can elect to be a real property trader business or a farming business. So looking to see if you fall into these exceptions may allow you to not have to look at your business interest and see if it's limited. Something to point out just quickly with that too. So the small business exception, of course, there has to be extra complexities. There is complexities around who do you have to include if you have related companies and related ownership. So it's not quite as easy sometimes as just looking at the company, but sometimes it is. But there's something there to keep in mind. But in general, to look at how your interest expense is allowed, generally what we see now after 2018 is you can take business interest expense deduction in the current year up to 30% of your adjusted taxable income. So prior to 2022, we were allowed to add back certain adjustments to get to that adjusted taxable income to bring it up. And so prior to this year, we could add back any depreciation expense taken, any amortization expense taken, depletion. So that would bring up this adjusted taxable income number. And then at 30%, you'd have to look at that business interest. Anything over that amount isn't eliminated, but it has to be carried forward and it can be used in a future year, sorry. Starting this year, we can no longer add back any depreciation or amortization expense. And so that adjusted taxable income number may be a lot lower for companies than they've had in the past. Also to take into effect during COVID, we had a little bump where you could take up to 50% income and have some other adjustments. So we don't have that in 2022. So that's something to look at while you're looking at estimates, is making sure that you understand how much business interest expense you will be able to use in the current year, since that might adjust how much of your net income is actually taxable this year. Oh, sorry, I jumped ahead there. So another attribute that we have to look at and have some changes with this year are NOLs. So NOLs are very valuable assets for our clients that, if you have a year that you had a net loss and aren't able to use that, you're able to, well, in the past, carry it back or carry it forwards to offset a year that there's income. And so when you can offset it in a year of income, if it was a past year, you could claim refund. And if you're using it in a future year, it would just offset income so you had less taxes in that future year. So before 2018, we could carry back our NOLs, generally 3 years, or elect to carry them forward to 20. After 2018, we lost the ability to carry them back, but we could carry them forwards indefinitely. A caveat also with how we use them, though, in the future years would be that in the year of income, when using them, you could use an NOL to take down your income by 80%, but you could not use an NOL to cover 100% of your income in that income year. Anything you didn't use, though, would still carry forward. So you weren't losing it, but it was making it where you couldn't bring your taxable income to zero. During COVID, we got a break and those regulations weren't put into effect. So we could still use our NOLs in ways that we could use them in the past. But starting in 2022, if you have NOLs that are created in 2018, those would be in a different bucket than your old NOLs that retain their character on how they can be used. But NOLs starting in 2018, when used in future years, so if you're using them in 2022, will only bring down your income to 80%. So something to keep in mind that you're not able to bring income all the way down to zero, since in the past we did have that ability.
Cass,
yeah.
let me add to the, under the CARES Act, Cass alluded to it, they suspended the 80% limitation for the losses, and they also opened the window back up for carryback. So normally you have a 0 carryback window on post 17 losses and a indefinite carry forward. Now, if you happen to have had losses in 18, 19, 20, they waived the rules that they were implementing and delayed implementation and allowed for a 5-year carryback and 100% offset in the earlier years. You still have losses after that. Then you're subject to the 80% limitation moving forward. But I wanted to mention that because we still see situations where taxpayers did not waive their carryback, which is something you have to elect to do. And they may be unknowingly losing the opportunity to utilize a COVID year NOL and carrying back and claiming a refund. You still have time to do that if you are someone in that situation.
Great point. Great point. And just another on this slide, we touch on section 382. So this is another limitation that comes into play with NOLs and your ability to use them. If there's been a significant ownership change, you may be subject to 382, which in essence puts a cap on how much NOL you can use from those older years moving forward. But this only comes into play with large equity shifts or that you would see. And then lastly, with our pass-through entities, our NOLs are created at our operating company level, but they're going to pass through down to other entities and possibly individuals. And so there are other limitations that come into play. So you'll just want to be cognizant of how are those limitations coming into effect at those other levels, not just looking at that top level there.
Do we want to answer the question in the poll? No, it's not a polling question, but the Q&A, there's another question there.
It looks like we have the ERC credit question. Scott, do you want me to tee you up for this one?
Yeah, if it's CARES Act, it's Scott.
So concerning ERC credits applied for this year, 2020 and 2021, are there any strategies for when to pay the taxes that become due for the prior 2 years? So this is an individual looking to amend the returns for those 2 prior years, so the wages used to create those credits, and then wondering if it's possible to claim the ERC tax credits as reduced expenses for this year.
So I can jump in and start, and Scott, you can clean up here. There are 3 notifications out there. The IRS has notified taxpayers regarding 2020 and 2021 employee retention tax credits. You may claim credits on wages that were not utilized for another benefit like PPP loans or FMLA credits or other credit programs that are out there. You can't double count wages, but you can still claim credits through the 3rd quarter of 2021. We're seeing a lot of these claims and there's still delays on getting refunds. So the question really is, when do you recognize the income? The guidance says you are required to recognize the income in the year the wages were paid, which means if you make a claim, you should amend those prior returns. There are a number of considerations in that process. I'll pass that to Scott to see what some of those discussions look like, but the right answer is you are required to recognize in the year the wages were paid.
Well, thanks for sending me the easy one, Mark. But no, the answer really is that the income needs to be included. The IRS has been crystal clear, even regardless of all of their processing delays and some of the timing mismatches. They've been crystal clear that the rules are you need to amend the return for 2020 or 2021. Now, there can be mitigating circumstances. If you have massive NOLs and there's no tax consequence, that's a decision that you can think through, but you are putting yourself potentially at risk of IRS audit by ignoring those rules. So if that's something you're concerned about, I'd encourage you to have a conversation with your advisor. But the rules are fairly clear that you have to amend the credit in the year of the wages paid.
Thanks, Scott. Thanks, Mark. So looking at some other planning strategies that we have, and when we look at minimizing taxes, we're always looking where we can defer income or, exclude taxes. And so capital gains, we see some opportunities there and still have some opportunities. So something that we've been hearing more about, though it's been around for quite a while, is that there is ability to exclude gain on the disposition of qualified small business stock. And so this would be stock. There's 8 requirements that the stock has to go through an order for it to qualify for an individual to be able to sell it and to exclude all or part of the gain. Part of it being holding period and other things with the stock, but it's something definitely to look at if you've held stock directly for 5 years to see if it possibly falls into this bucket, because there is a large exclusion to entire exclusion of the gain on that stock. We're also looking at other kind of gain deferral strategies. Like-kind exchanges, which people were familiar with in the past, are still there. The caveat is it's only available for real property. So when we look at this, we're looking at buildings. So buildings held for investment or for business, active business or trade, those can still be exchanged. And the gain that you would have recognized had you sold the building outright is rolled into that next property and can be recognized then, or if it continues rolling there. But the change with this one is that it's only available for real property. In the past, you would have kind of thought of like-kind exchanges when you thought of cars and maybe fleet vehicles. And now it's not available for tangible property, really just real property. Another strategy that is still out there, but slightly changed, would be the use of qualified opportunity zone investments. So this would be a strategy. If you had large capital gains in a year, you could invest those gains. It actually doesn't have to be the full proceeds you receive from the sale, but just the gains from those sales into a qualified opportunity zone property or fund. There's a lot of requirements to make sure that it stays or is a QOZ. But if it meets all those requirements, the gain that you've put into that investment would stay deferred until the earlier of selling that new investment or 2026. So the gains have to be paid at that point, but it does give us a few year deferral there. In the past, there used to be an ability to actually eliminate some of the gains by receiving a step up in basis, but due to the holding period requirements and the fact that we're in 2022 now, you're not able to meet those requirements. Something to note with that, though, is that right now our capital gains rates have stayed at the same rate right now. So we're at 15 and 20% maximum capital gains rates. If you were to defer gains in any of these transactions, actually, the rate that's instated in that year that you pick up the gains will be the rate to use. So you're not guaranteed that you'd have this still 15 or 20% rate that we have right now. And lastly, we actually touched on this when we were talking about the reverse ability to kind of reverse your normal planning, but the use of installment sale. So that's still a fairly common way to spread gains, and that way you're able to spread gains over multiple years. Allows you to use lower brackets and maybe offset if you know you have some capital losses coming up. Allows you to place those timings to put the losses and gains together to help your overall tax situation.
Cass, I'll jump in real quick and answer a Q&A question about qualified small business stock. The question is whether stock from 1980 would qualify. Unfortunately, this act was enacted in 1993. So it's only stock that is issued after 1993 that would be eligible.
It's a good question. That's a nuance that is often missed. If you can meet the other requirements, you do need to have a certain stock, and you also need to know the exclusion, which is 100%, changes depending on which year you purchased or invested in that company. So if you do happen to have invested post that magic date and held it 5 years, and it is a qualified business, you can exclude the greater of whatever that limitation amount is, 100% now if it's a qualified small business stock for most recent acquisitions, but it has been 50%. It's been different percentages, but it's up to, I think, $10 million per taxpayer as well.
It is. Great, well, thank you. So moving ahead to tax credits, and as many of you addressed, year-end tax credits are definitely something that you want to take a look at and see if there's any that work for your business and your activities. I'm sure most of you are pretty familiar with a lot of the credits that are listed here. So in the interest of time, we won't go through each bullet point. But I did want to point out some of the newer ones. So kind of the CHIPS Act, I was about to say, there's some changes to some of these as they go along, but the CHIPS Act at the bottom, that's the newer one that Mark was referencing earlier. That was recently enacted to support semiconductor manufacturing. And then there are several new and extended energy efficiency credits that were in the Inflation Act. So, you know, that was both for businesses and individuals. So there is a lot out there promoting the energy efficiency this year as we move through. And I forgot to make a notice earlier, but our polling question 2 is coming up right now too as well. So our polling question 2 is tax planning involves, and we have several options here, accelerating or deferring deductions, accelerating or deferring income, claiming credits, making smart elections, or all of the above. We got a lot of options with that
We should
one.
have some music.
We should.
We'll edit that in for those who want to watch this later on video. Can't guarantee double CPE credit, but it might be more enjoyable.
I know we said there was no right answer to the last CBE polling question. There might be some right answers on this CBE polling question, but you will still get credit as long as you make a selection.
There we go.
Good responses, everyone. Thank you.
And so now we just wanted to touch on some specific planning opportunities to consider for those taxpayers that have flow-through entities. So one thing that, you know, it's been around for a few years, but something to think about is the qualified business deduction, income deduction. So this is available depending on your type of business. There's a 20% deduction available at the individual level for qualified business income. Something to keep in mind with this, though, is it is limited by certain factors, which is based on the amount of wages the company itself has and other cost basis factors. So this may need to be looked at just to make sure that you're maximizing the amount of deduction that's flowing to the owners. We always recommend making sure that that's reviewed because there's some simple year-end solutions that can be applied to make sure the owners receive the maximum deduction there. Other thing to keep in mind too for owners is reviewing your basis limitations. So, you know, we would always want to make sure that our owners are able to take any losses that companies are passing through. And so looking at basis and looking at debt allocation that's out there needs to be a consideration to make sure losses that are passing through are actually usable by owners, and to make sure as well that losses aren't being passed through to owners and deductions are being looked at and distributions being looked at so that income isn't accidentally being created at an owner level by how allocations are being handled at the top entity level. And then lastly, and this kind of goes to my almost to my prior point of making sure we're getting rid of assets that don't have benefits sitting out there. So if you have passive activity losses, if you have entities, passive entities that you've invested in and they've been accumulating losses over the years, those losses have been carrying forwards while you haven't been able to use them. Now, maybe there's, you know, another activity you have that has passive income and they're offsetting and so they're being able to be used. But if not, and if it is a worthless investment, it may be worth looking at how to abandon the asset so that you trigger the losses. And then all of the loss, those carryover losses would be fully deductible in the current year. The key here is triggering that abandonment before year end so that you could use it on the current year return.
Yeah. And you can write a letter to the fund manager to control the timing of that. Did want to mention real quick before moving on. Yeah. One of the energy incentives that were added or expanded was 179D. Historically, you could deduct up to $1.80 per square foot of a building that meets certain energy efficiency standards. It's used in your business or rented. If it's certain type of property, commercial property generally, or above 3-story multifamily or mixed use assets, you could take this cost segregation deduction, which can be valuable if you're not planning to sell your building in a year. So if you have any large renovations or improvements, expansions, additions, or new building acquisitions, you can do a cost segregation study to trigger those deductions. Beware, Cass just mentioned basis limitations. Partnerships and S corporations are different types of entities that have different basis limitation rules. The main difference, and one of the most distinct differences that creates a benefit for partnership structures, is the ability to use your share third-party debt for basis purposes. So if you're an S corporation and you don't have a lot of basis and you're considering cost segregation studies, that may not help you right away, but it could generate a deduction to offset income in the future. You might have a different result with a partnership structure.
Very true. And lastly, I'm just going to touch on this slide with just a couple points here, but a large new planning opportunity that we've had over the past 2 years, and more so this year for Georgia owners, is the ability for pass-through entities to pay the state income tax for their owners at the entity level versus having the owners, pay that state income tax. So by paying it at the entity level for states that allow this election, it's giving a federal deduction for those state taxes paid versus them being limited to $10,000 as an itemized deduction on an individual return. So all the states are different, of course. And so state by state, the way you claim the election, the method of claiming the election, the timing is all a little different. For Georgia, this became an available election for the 2022 tax year. And if you have a company that is going to be paying state taxes for their Georgia sourced activity, then those payments or those tax estimates need to be paid in by December 15th. In order for that to qualify so that they can make that Georgia election that they're going to be paying the tax at that entity level versus the individual level. All states are different. They're not all requiring it by 12/15, and not all states are allowing it. It really is a state by state analysis that you have to take. And there's some considerations to take into effect too. It's not necessarily a windfall. If you have losses from other companies that you would be able to net together at your individual level, by making a state election, you may actually be increasing your overall state income tax burden because you may not be allowed to offset those at the individual level. And then really looking at how all the different states play together. So for most of our clients, we have found this is a huge tax benefit, but we've also run the numbers and realized that actually it did not help a few. So it's definitely one of those things that you need to take a look at and really look at your unique situation. And that's going to be different for each taxpayer. And then lastly, this actually was going into the basis kind of comments that Mark was making earlier, looking at what type of debt creates basis for partnerships. And relying on the transition rules. So this is in regards to partnership liability, giving basis to partnership owners to at the partner level, looking at this for 2022 as well. So I believe that is all we have here. We're going to roll into the international planning here.
Good afternoon, everyone. We are going to run through some international tax planning considerations, some employee benefits, and then I will close out with some state tax considerations. So if you don't have international tax operations, you got about a 5-minute nap ahead of you. We'll try to keep this part brief since it may not apply to too many folks. The first item here is our foreign tax credit limitation. So this area of foreign tax planning and international tax planning has been under a lot of change over the last few years. And as of 2022, we have some finalized foreign tax credit regulations. These regulations have been out for a number of years, so they're not a total surprise, but the finalization of those regulations do have some significant impacts for certain taxpayers. the takeaway is that if you have controlled foreign corporations, so subsidiaries or brother sister corporations, primarily your biggest changes are going to be located in South America or Asia. So if you have a manufacturing plant in Brazil, you need to be aware of these foreign tax credit changes and what types of taxes and income qualify for the credit. Another big consideration for folks with controlled foreign corporations in 2022 is we've had some foreign currency exchange changes. If you are doing business in England or in the Eurozone, you are probably well aware of this. And so those foreign currency changes provide a really strong and fairly unique opportunity to potentially realize some ordinary losses, because for those businesses that have been in existence, those foreign businesses that have been in existence since 2017 and prior, you had to pay transition tax on all those foreign previously taxed earnings. And now, based on those changes in foreign currency, you have potentially a unrealized loss on your books that you may not be aware of. And so now may be a great time to repatriate those earnings into the US and realize that foreign currency fluctuation. This can also, of course, go the other direction, but the Eurozone and the UK are the two primary jurisdictions where we're seeing planning opportunities. That also covers that previously taxed earnings and profits bullet. Global intangible low taxed income, everybody's favorite topic. No major changes here for 2022, just a reminder that we have to factor that in for US tax purposes. So if you're thinking everything's same as normal, same as last year, but you had a lot of changes in your foreign operations because of inflation, because of currency exchange rates, you need to consider how that GILTI tax, which is a US tax regime, will impact reporting of those foreign obligations. So on the topic of supply chain and disruptions, as we have dealt with all of those foreign currency exchanges and those supply chain issues, this is a great opportunity to review your transfer pricing. So this is agreements between internationally related subsidiaries or brother sister corporations. So accountants love to say, let's do it like we did last year, but that may not be appropriate in 2022 based on all the upheaval we've seen. So for any agreements and pricing changes that need to be reflected, those need to be incorporated before year end, even though your transfer pricing report takes a whole year or longer to get completed. That covers that second point as well, making sure that all of your cross-border transactions have been identified and priced at a third-party length. It's also important to keep in mind that you understand which entity and which location controls your intellectual property rights. That has a big factor to play in transfer pricing negotiations. The other thing that's been in the news on foreign currency and foreign operations is really this global 15% minimum tax that was agreed to by the OECD. Nothing is set in stone, nothing's in play here yet, but it is important to keep in mind as you start to do longer term planning for your international operations. All right, international tax done. You can come back to the land of the living here. So employee benefits are a huge key factor, as Mark mentioned earlier, in retention and attracting talent in this market. And another thing that we often see is retirement plan contributions just being a great opportunity to attract and retain folks, and also for potential for small business owners to reduce those ordinary income tax rates. This is one of the most common and easy ways to do just tax planning for almost any size, any type of business. There's a lot of different types of plans here. Some of these can be done after year end, meaning before you file your tax return. But if you're terminating a current plan, you may need to address that before year end to address discrimination rules and other employee benefit rules. And if you don't have enough time to get it set up for 2022, now would be the time to start thinking about 2023 plans and making sure you're taking advantage of the maximum retirement plan allowances for your business. Another piece of attracting and retaining talent is these fringe benefits that we're seeing become more and more common. A very popular one that's available through the recent bills is actually student loan debt assistance. So this is like a cafeteria plan, an FSA plan, where you're allowed to reimburse up to $5,250 in student loan debt for your employees through 2025. So that can be a very powerful tool if you have a particularly young workforce or really anybody that's dealing with student loan debt. Another thing to keep in mind as we do expand our tax-free fringe benefits and our fringe benefits is that not all fringe benefits qualify under IRS deferral rules. So things like mental health and Headspace and gym memberships, they may not meet those typical tax-free fringe benefits, and they may need to be included in W-2 payroll reporting. That's okay. You just want to make sure you understand those rules. So if you've added new benefits for 2022 or are thinking about it for 2023, make sure you have a conversation about what that taxation impact looks like. All right, now we're moving on to state sales and local taxes. So this has become an ever increasingly important topic. As we've all transitioned to having more of a remote workforce, and states have woken up in the after effect of the Wayfair case, which allowed remote sellers to be taxed for sales taxes, states have said, you know what, I want some of that money too, and they're applying these economic principles to income taxes. So just because we've only filed in a few states historically over the last 30 years, we have to review and evaluate what our state tax impact looks like. So the three key things are stuff, so our property, employees, so our people, and then our sales and our revenue streams. Where are they coming from? Where are they sitting? And what does that mean for our business? Now, there are 50 states, and guess what? There are 50 different rules that we have to consider about what that looks like. So for the next couple of slides, we'll walk through at a very high level, not state by state, because I know you have stuff to do, but we'll walk through at a high level what some of these things are that you need to consider. And one other note here is that in 2020 and 2021, a lot of states had temporary COVID restrictions or relaxations of their rules. So they said, you know what, you have remote employees here, it's okay. That's not going to change your requirement to file state taxes. We're going to give you a break. But if that activity has continued into 2022, pretty much every state has said, hey, now you have somebody sitting in Oklahoma, in Idaho, in California, wherever it is, I want a piece of that pie, and you have to think about filing state income taxes. So, as we mentioned before, there's some planning opportunities that come with this. Each state has different methods and opportunities to file, whether it's on a combined basis, a separate basis, and there's a lot of other potential nuances that we could look at to minimize state tax burdens. Going back to international, some states have options to include or exclude foreign activity. So that can be a big difference on these state tax impacts. Filing consolidated versus separate also makes a big difference when you have a profitable company and a loss company in the same family. S corporation elections, that's another thing that's important on the state tax level. And then the disregarded entities. So that's our single member LLCs. Our friends in Tennessee and Alabama love to treat those entities different than we would normally think of on a federal level. So if you've generated or created new single member LLCs, that's a conversation piece to consider for state tax planning. So all these great planning opportunities, these credits, these other things we've been talking about today, guess what? When we look at our state tax returns, we have to think about, what do they say about them? Do we get to include them, exclude them, multiply them by some new made up percentage that the state agreed upon? So there's a lot of additional thought that has to go into these state returns that's separate from the federal consideration. State net operating losses and tax credit carrybacks. Again, we have to look at those attributes on a state by state basis. And on the plus side of the ledger, so a lot of these states do have research credits. They have credits for making, plant and business investments. They have incentives for hiring people. So if you're growing in a state, you've added people, you've added stuff, those are potential dollars back to your business that you need to be talking about with your advisor. So we mentioned all about activities in the state, and the key takeaway here is that personal property, services, and intangibles can all be sourced differently depending on what state we're in. So it's not enough to just say, well, my customer's located here, or I shipped it from there. We really have to think about what we're doing and where it's going and who the ultimate user is of those revenue generating activities. There's a couple of other things like, do you have a secondary revenue stream? Do you have investment income? Maybe something that's non-business that doesn't need to be included in our whole pie of sales receipts. So that can make a big difference in adjusting your sales factor into potentially more favorable jurisdictions and lowering that state tax effective rate. These are all things that on their own aren't going to make a material difference, but a methodical, intelligent approach can really move the needle when done on a combined basis. If you had a liquidity event, you sold some assets or you sold a business, you need to think about what that state tax impact looks like. It's fairly easy to think through your federal impact, but a lot of advisors and a lot of people don't think about where those state taxes come into play. And we're talking 5 to 7 to 9% potentially that needs to be managed and planned for on these liquidity events. Lastly, we have different apportionment factors depending on what business you're in, manufacturer, transportation, financial, all of those have different rules to consider. We talked a little bit about merger and acquisition and disposition transactions. Again, it's better to plan for these things on the front end and consider that the state tax treatment might be different than just selling a widget into a state. Lastly, if we're going through and we're amending federal returns to claim an ERC credit, we do need to think about the state tax impact. While some states don't tax the ERC and they say, you know what, we're going to treat it like PPP, we don't want that money. There are a lot of states that don't follow that treatment. So we do have to think about those things at the state level as well. We touched on this a couple of times already today, but this state pass-through entity election is a big deal, and 2022 is probably the most states yet that have come online. There are 30 states that have some form of workaround allowing a pass-through business to pay the state tax and essentially circumvent that itemized deduction limit. Now, that sounds great. It seems like a no-brainer, but we have to consider that each state has their own rules, so each entity may not be eligible to take advantage of this benefit. You also have to think about things like losses and 163J limitations, and something that sounds great on the forefront may actually be a trap, and you may spend a bunch of work and time planning just to get to the same or worse answer. So be careful about jumping at these opportunities. They're worth evaluating, but there are some considerations that need to be taken into effect. And I think we're getting to the end of the state tax analysis here. So we've been talking about income taxes. We can't forget about our sales and use tax. That's what started a lot of these nexus considerations. So as we do have employees in other states, as we are expanding our footprint, we do have to think about our sales and use tax. The states are getting much more aggressive about going after these remote sellers. The materiality thresholds are dropping. $100,000 in sales is often more than enough to require registration. Even if you've never even been to this state, you couldn't find it on a map, you may have to be registering for these sales taxes.
And I'll add, my state and local tax partner and the founder of our sister firm, Nexus Solutions, that handles a lot of sales tax compliance. He will tell you, he's got a 10-step checklist to success. Number one on that checklist is call Tim Howe if you have a question. And the time to ask those questions is before you start selling into different states and jurisdictions, because everybody does it different. If there's 50 states, there's certainly over 2,500 discrete jurisdictions for sales tax, property taxes, its own animal as well. You need to be careful with that. And there is a smart way to navigate through those states and rules. But number one, I would recommend calling Tim Howe.
Yeah, that's a great shout out there, Mark. Last thing on this slide before we move to the final portion of our presentation today. If you get a crazy property tax bill based on these increases in market value, don't just automatically pay that. There is potential to challenge those property tax bills. That's another time to call Tim Howe and discuss what viability there may be to go back to the assessed value versus their new market value. And with that, I'll throw it to Mark. I think we have our final poll question here coming up in a slide or two. And Mark, take us home.
All right, now on to the topic I know I all love, accounting for income taxes. So one of my partners, and we have a specialized group that handles a lot of the ASC 740 accounting for income taxes, would love to help you if you're taxable corporation that is required to disclose income taxes, you can listen here. Generally speaking, as you think about all these changes we just rattled off, it's really better to start planning now to capture the changes in your income tax provision. Some filers require quarterly reporting, depending on the whether they're registered or not. You may have different periodic reporting requirements with lenders. You really need to think closely about how you capture this and when you capture this information in order to make that process as efficient as possible. There's a number of standards that are changing that we haven't discussed today with lease standards or revenue recognition. You really should get your ducks in a row to try and make sure you have a streamlined process and you're coordinating all of that with your income tax planning team and your provision team, whether that's internal or external or a combination of the above. So there are a number of impacts. If you take advantage of accelerated depreciation or you're considering it, you really need to start thinking about that now. Start your studies now, get your R&D studies moving. There's things you can be doing now to try and get ready for filing returns and certainly paying estimated taxes and extension payments that will be due in Q1 of 2023. The changes obviously can be assimilated. Some are prospective. I will say that you have a number of those credit provisions that are 2023 provisions, but certainly you need to think about when those are going to affect your business. If you're in a different situation, let's say you have expiring credits or attributes and you've got these deferred tax assets related to old NOLs or old credits or old loss carryovers, you will have to consider what the effect of the expiring window might be on those attributes. Or if you have a going concern, maybe those deferred tax assets for suspended losses are not valuable. You will never realize those. You should determine what the proper period is for including or reversing out through evaluation allowance your deferred tax assets. Determine and document the tax accounting effects of business combinations, dispositions, and other non-recurring transactions. Not all M&A transactions are the same. Asset acquisitions might be relatively more straightforward in some senses than a stock acquisition. Generally speaking, you have carryover basis attributes for tax purposes in a stock acquisition. For financial statement purposes, you may book up that acquisition in your combination accounting, but it's going to create a difference in your income tax effect. If you are booking that in the first year, or if you're starting a new business, you might have an opening balance sheet deferral difference, but you certainly have ending differences that you need to account for in that period. And if you don't get the beginning and end right, there's no way the intra-period allocations are going to be right. So it's really important that you start looking at that before you, way ahead of getting to the financial statement reporting date. And I mentioned previously, if you are certain listed filers are required to do quarterly reporting. There's also business combinations and consolidated reporting where it's important to get your provision right on a company by company basis. So this is not something you want to tackle at the extended deadline. This is something you want to be doing throughout the year to make sure that you're putting yourself in the best position to comply with all the rules and changes that we just discussed. There are also uncertain tax positions. Scott mentioned, hey, for 30 years, you may have been filing in 3 states. Well, maybe you had exposure in 20 states. For the most part, we will, with our clients in every situation, ask and use good business judgment. And those aren't material positions that we're taking if for some reason you decide not to file. But if you have a large exposure, we're recommending filing. However, it is possible that you should have filed somewhere and didn't. In some cases, that might create a material tax liability that you're required to book under ASC 740. And not only do you have to book the actual tax that you didn't pay, you could have to book interest and penalties as well. So it's time to evaluate those now. Don't wait till the last minute to do that. If you're trying to clean up your books or certainly disclose for a transaction, you want to make sure you get all these things updated as soon as possible. Ensure that your tax account reconciliations are performed timely and with sufficient detail so that someone like me or your external advisor could understand what those attributes are, whether you have ledgers for prepaid expenses or taxes that you've paid. Certainly some of the different types of assets on balance sheets can be taxed differently or treated differently for tax purposes. And many of those method changes we were talking about before are going to require more detailed account analysis in order to get to the right answer every year. And we have to have that every year. It has to be carried forward and reconciled from period to period as those balances flip around. Also understanding what you're required, and we do have a polling question coming up, so please run back to the computer screen now. It's good to understand where you're headed before you start. So if you understand what that requirement is for footnote disclosure purposes, whether you have current and deferred attributes and the components of those and material disclosures that are required, or rate reconciliations that are required, you want to make sure you're building your processes up right now so that you can get to the right answer the first time you do this and have a complete file. If you don't have a good internal system of doing that, you certainly can collaborate with your external advisors like us to make sure that you're doing everything possible to get your provision ready for financial statement. Now we're going to have our third polling question. What is an example of a permanent tax saving strategy? One that generates permanent tax savings. Deferring gain into an opportunity zone fund, deferring gain under section 1031, i.e. a like-kind exchange, or purchasing or establishing a credit for research and experimentation expenditures, really your activities generating a credit. There's a right answer here too.
I think I know this one, Mark.
That's right.
I feel pretty good.
You don't have to get the right answer, just answer it. Click a button. My dog likes to counter search, so occasionally I'll lock him in my office, make sure he gets those polling questions answered. All right, very good. Credits are definitely permanent differences. Thank you for your participation. Let's see, let's advance this slide. Yeah. So we're wrapping up now. We're kind of getting to the close of the presentation, and we'll open up for Q&A. I see there is one, so bear with me for 1 second. As you think about your taxes and planning, now's the time to do it, of course. There are things you can do before the end of the year, like purchase equipment or strategies you can employ that might help with tax savings, whether you are accruing retirement plan expenses or comp or whatever, and the timing of your payments on those vary, but you can get deductions after the end of the year as well. It's important to look at that. Also, if you're from a financial statement perspective, reporting your tax provision, you have to think about total tax transparency, making sure your team is understanding and has full visibility into your approach to your tax calculations and how that contributes to the bottom line on a unit by unit basis. If you have divisional reporting or combined reporting, you have to try and think about what that looks like, even intra-period reporting. Mentioned a little bit earlier about choice of entity. There may be limitations once you get started down one path. There are issues with changing, but if you're starting new things or considering changing what you're doing, there could be benefits to whether you're an LLC or an Inc. or an LP. Also, what type of taxation each of those might involve, including taxable corporation, disregarded entities, and partnership structures. A lot of times you see some or all of those entities in business transactions. They may be necessary in order to accomplish tax-free rollovers and things like that. So you could see a combination of entity structures even for a taxable corporation. It's also true that if you have those types of things and you have rollovers, that could affect your tax provision. Some things will have the same book basis as tax basis. Some things won't. That affects your accounting. Evaluate your global value chain and cross-border transactions to optimize your transfer pricing and minimize global tax liabilities. It's true now that we have a water's edge kind of approach post 2017 transition tax, but it's also true that there are still low tax jurisdictions, even though we don't have a global minimum tax that Scott alluded to earlier. There is still the possibility of shifting income to low tax jurisdictions. And if you don't have a transfer pricing study or report that adopts one of the safe harbor methods under the code, you should, depending on the materiality of those transactions, consider that right away, start planning for it in order to support your interjurisdictional income allocations. You should review tax credits. We talked about a number of them. Some are available this year. I mentioned 179D and cost segregation studies. You should start thinking about those. Next year, 179D goes up to $5 a square foot, up from $1.80. So when you place buildings in service could have an impact on that analysis. There's a lot of other provisos and rules within those provisions that are hard to attain, like what is a prevailing wage and how much does that mean for jurisdiction on whether you get these higher incentives. They're hard to navigate and a lot of times hard to attain because they're higher than what our normal contractors are paying for wages. So energy efficiency standards come with a little bit of baggage. It's hard to get to the max benefit, but if you plan for it, you might get there. Consider legal entity rationalization, which can reduce administrative costs and provide benefits and efficiencies. Consider benefits of an ESOP transaction as an exit strategy. You can get to a strategic value with an ESOP, but you got to have good people to run that company and make sure those seller note payments are made. An ESOP for C corporations gets to a deferral or exclusion. A deferral really, if you reinvest the proceeds into qualified publicly traded securities. For those owners and flow throughs, you can still do it, but it's more of an installment sale transaction. And lenders still, if you're working with the right lender, can finance 50 to 60% of the full value, and the sellers can finance the difference. I mentioned cost segs already. I'll skip that for interest of time. For provisions, if you don't have a good team or a well thought out internal function how to approach your income tax provision, you can work with people like us or totally outsource it to people like us. Consider that as you approach your financial statements. Make sure that you're using all your resources at their best possible function. Be aware of proposed and pending legislation. We didn't touch on a lot of this stuff, but there are new 1099-K rules. Third-party payers like Venmo and Cash App are having to issue more 1099s. For most of our clients that have sophisticated accounting systems, this isn't much of an issue, but if you're a cash basis taxpayer and Schedule C taxpayer, maybe you've got some additional income that you haven't reported before that you need to think about, right? So it's different for different situations. There are other things that are true that we haven't necessarily addressed today. If you have questions about them, I want to encourage you to reach out and ask. For example, meals entertainment paid to local restaurants, if you're there eating with your customers or vendors, are still 100% deductible for 2022, I believe. Those rules are changing though. Whether you get to a 50% deduction or 100% deduction can change varying on what year you might be in. So just think about that. Entertainment's still not deductible. The normal rules still apply. We need to think about that in addition to all these other changes and method considerations as we approach your year end and plan for taxes. There's another question in the poll. I think I'll scroll over that and see if we can answer that. And I'm going to then open it back up for more questions.
That's Nancy giving a shout out for Tim.
So I don't know if everybody can
sales
see
tax.
that, but we can send this afterwards, certainly. But if you need assistance for state and local tax compliance or would need help with your sales tax compliance itself, please reach out or to our website. Go to www.synexustax, that's synexustax.com. And then there is a contact link on that page. If you would like more information on sales tax, please reach out. If you have any other questions, please publish those now. We are right at time. We have about a minute or two left.
Our contact information is also up here on the page. Please feel free to reach out to any of us. We really appreciate everyone's time and attention today. We hope you found at least one or two nuggets that you can take home and think about for tax planning purposes, and we're happy to explore those further if you think it may be applicable.
That's right. Take your phone out right now and take a picture of this screen. That might be the most important thing that you do in this hour and a half. Okay, with that said, it looks like we're about at time. I'm going to close it out. Thank you everyone for your attention. We're happy to answer questions post call, as Scott mentioned. Cass, thank you. Scott, thank you. You all did a great job. Misty, Nancy, Grace, to all of our marketing team, thank you very much for all the assistance you contributed to this presentation. Looks like there aren't any more questions, so we're going to end here. We hope you can join us December 15th next week for our personal tax webinar as well. There will be more CPE there for those who are really trying to cram it all in. Our contact information's up. Have a great rest of your day and happy holidays.